Welcome to this explainer. Today, we're unpacking the actual mechanics of corporate finance to figure out if corporate payouts are really the free money they seem to be. Look, if you hold shares in any major company, you definitely know that thrill of a dividend hitting your account. But what's really going on behind closed doors when a board of directors decides to dish out that cash? Let's get right into it.
So here's the central mystery we're tackling today. Does getting a dividend actually make you richer? I mean, it feels like a bonus, right? You just got cash. But, well, in the rigorously mathematical world of financial theory, the truth is a lot more complex and honestly way more interesting than just free money.
Here is our roadmap for navigating from perfectly clean financial models to the beautifully messy reality of the stock market. We're going to hit the dividend irrelevance theory, real-world market imperfections, the clientele effect, agency costs and cash flow, the signaling hypothesis, and finally, the residual theory of dividends.
All right, Section 1, the dividend irrelevance theory. To start, we have to look at the Miller-Modigliani, or hypothesis, which kind of pulls the rug right out from under us. It evaluates the logic of dividend irrelevance, arguing that in a mathematically perfect market, a firm's value is completely unaffected by its dividend policy. Imagine a utopian world, right? No taxes, zero transaction costs, and every single investor is perfectly rational. Under those exact strict conditions, a company's value is driven purely by its earning power and its investments. How they slice the pie, whether they hand you cash right now or reinvest it back into the business, doesn't actually change the total size of the pie itself.
This brings us to a brilliant concept that proves the logic, the homemade dividend. Think about it like this. Say a company decides to keep its earnings instead of paying you a dividend. Well, theoretically, the share price is just going to appreciate by that retained amount. So if you, the investor, really need some cash to spend, you don't actually need the company to declare a dividend. You can just whip up a homemade dividend by selling a tiny fraction of your shares. And since you're selling them at that newly appreciated price, your total net wealth, completely unchanged. Mathematically speaking, it's a perfect wash.
Moving on to Section 2, real-world market imperfections.
But here's the catch, right? When we contrast those perfect assumptions with actual reality, we instantly see that dividend policies do matter immensely. In the real market, selling shares to create that homemade dividend, that triggers broker commissions. Plus, information isn't perfectly free. Company insiders know way more than we do. That's information asymmetry. And crucially, dividends and capital gains are almost always taxed at totally different rates. The second we introduce these real-world frictions, that perfect hypothesis breaks down. These are the exact market imperfections that make a company's dividend policy highly relevant to you as an investor.
Which brings us to Section 3, the clientele effect. Because of those imperfections we just talked about, investors naturally sort themselves into distinct groups or clienteles. They choose stocks based on what they actually need in their own lives. Take a retiree, for example. They might be in a lower tax bracket and really rely on steady current income to pay the bills. They're going to naturally flock to companies pumping out high regular dividends. But on the flip side, picture a wealthy executive in the absolute highest tax bracket. For them, a cash dividend is basically a steep tax penalty. They vastly prefer companies that hold on to their earnings to drive up the share price, since capital gains are usually taxed at a much lower deferred rate. So essentially, companies attract the specific type of investor that perfectly matches their payout policy.
Next up, Section 4, agency costs and cash flow.
So what happens when managers have way too much free cash flow lying around? Well, they might get tempted to blow it on unprofitable vanity projects instead of returning value to the shareholders. Honestly, it's a bit like leaving a teenager home alone for the weekend with a loaded credit card. You have the owners, the shareholders, the principals, who just want the firm's value maximized. But then you have the managers, the agents, who might decide they want luxurious corner offices, huge bonuses, or to build a corporate empire by buying up other companies, even if those deals actually lose money. This frustrating gap in goals creates what we call agency costs.
To rein in this agency problem, dividends act as the ultimate allowance control. By committing to regular dividend payouts, a company effectively drains that excess free cash flow right out of the manager's hands. So if management suddenly wants to launch a big new project, they don't have a massive pile of idle cash to just play with. They're forced to go out to the external market to raise new funds. And you know what happens then? They have to justify their big plans to ruthless bankers, skeptical analysts, and new investors. That intense level of market scrutiny keeps managers honest and tightly aligns their actions with what the shareholders actually want.
Moving right along to Section 5,
this signaling hypothesis.
Because of that information asymmetry we mentioned earlier, where the insiders know way more than we do, dividends are incredibly sticky. What I mean by that is, a sudden increase in a dividend payout isn't just a random act. It's a massive, confident signal from management that they expect permanently higher future earnings. See, managers absolutely hate cutting dividends because the market will brutally punish the stock price if they do. So they actively try to smooth them out. They're only going to raise that dividend if they are completely, 100% certain that the company's future cash flows can sustain the new higher level. In a corporate world full of PR spin, cold, hard cash is the ultimate truth teller. That is the real information content of dividends.
And we know this signal is incredibly credible because of something researchers call dissipative costs. Basically, poor quality firms just can't afford to fake a dividend increase without seriously hurting themselves. If a struggling company tries to mimic a successful one by jacking up its dividend, it's going to run out of cash fast. Then they'll be forced to pay steep transaction costs to raise emergency external funds, or worse, they'll have to pass up genuinely good investments just to keep paying out that fake dividend. Because the penalty for faking this signal is so incredibly painful, we, as investors, can completely trust that a rising dividend is a genuine sign of a healthy, undervalued firm.
Finally, Section 6, the residual theory of dividends. The residual theory makes a really practical argument. Firms should first fund literally every single profitable investment opportunity they have on the table, and then just hand out whatever cash happens to be left over. It's a super logical four-step process. First, identify all the projects that will give you a positive return. Second, figure out exactly how much equity you need to keep your optimal debt-to-equity ratio intact. Third, dip into your retained earnings to fund that specific equity portion. And then finally, step 4, if and only if there's cash left over after fully funding all that growth, that leftover residual amount becomes your dividend payout.
This theory is beautifully grounded in hard data when you map out different investment schedules against the marginal cost of capital, or the MCC curve. The whole core principle here is that a company will only keep funding new investments until the expected marginal return exactly matches that marginal cost of capital. So, say a firm has an absolute ton of great investment opportunities. They're going to reinvest heavily, meaning that residual dividend payout is going to be basically zero. But if they lack profitable projects to invest in, they stop investing way earlier, and that leaves a massive pile of residual cash sitting there ready to be distributed to the shareholders.
So, I'm going to leave you with a provocative question to evaluate your own portfolio. Based on everything we've covered, are you sitting in a high-yield clientele just because you need the income? Or are your dividend-paying stocks secretly signaling super strong future earnings to the wider market? I really hope this explainer has given you a completely new lens for looking at corporate finance. We've taken what seems like a simple, free cash payment and revealed the complex web of market frictions, agency controls, and deeply coded corporate signals behind it. Thanks so much for joining me.